español, pero Dani es mejor
Sí, se escucha.
Okay.
Can everyone hear in Spanish that needs to be hearing in Spanish? Daniela, can you confirm that with us? Actually, maybe you'd have to do that. So Danny is putting in the chat that pauses are appreciated, Isaac.
Just saw that. Yep. And she just said, I just confirmed we are good to go.
Okay, great. So I'm going to share my screen. And then just let me know when you need to change the slides. Can you see my screen right now that has your slides up there?
Yep. I see the Spanish. Yeah, I see Spanish, and I also see on the right side in English your Google slides.
Okay, so that's what we should be seeing. They do look to be two separate decks here, but I think I can try to work this out this way. So bear with me. Okay, it's all yours, Isaac.
Okay, perfect. Hello, everyone. Like I said, my name is Isaac de los Santos. I'm happy that there's an interpreter here. I wish I could do it all, but I think you guys will laugh at my my Spanglish. I'm from, my family is from Dominican Republic. I can't speak Spanish, but I think we're in good hands with Danny over here. So I'm gonna go over you know, small business loans, what a bank looks at when it comes to lending. And if there's any questions, I'm more than happy to answer it. I prefer being able to just go back and forth with questions because every small business loan is going to be different. And we can just jump to the next slide. So what we're going to be talking about is, you know, what are small business loans? There are many different types of loans, and depending on your need, it's going to be different. We're going to talk about how small business loans work, how to apply for a loan, and then, you know, we're going to talk about what a bank looks at when it comes to lending. You can jump to the next slide. So how do small business loans work? So what a small business loan is used for is pretty much to, in a way to, oh, sorry, okay. So when it comes to small business loans, we want to make sure that business owners are able to invest in their businesses, purchase, whether that means purchase equipment, fund day-to-day operations, and just grow their business as well. So, you know, if we were all millionaires here, we may not be talking about small business loans. But what small business loans allow us to do is it allows us to make large purchases and investments without the need of having all that cash there. I'll pause there for a second. Maybe I'll give it 10 seconds or so. Okay, we can jump to the next slide. And just let me know if I'm going too fast, okay? So this slide shows just a few examples of the types of loans out there. And I'm just gonna go over them. You know, between these three different types of facilities or loans, there's even more types, but these three are usually the general idea. So we have term loans, which is you receive a lump sum of funds, right? So if you're going to apply for $50,000, the bank will give you a $50,000 amount into your checking account. And then you're expected to pay a fixed amount every single month until the loan is fully paid off. We have business lines of credit. So those are revolving lines of credit with a maximum amount. So if you think about something like a credit card, that's technically a line of credit because you're able to use it. And when you pay off what you owe, you can use it again. One difference is with a line of credit, you don't have the same payment every single month, and there's usually just a minimum that you have to pay. A little difference between a line of credit and a business credit card is, with a line of credit, you have access to cash. So you're actually able to use, you're able to pull it out and use cash instead of swiping a credit card. Usually with a credit card, you do have cash access, but it tends to be around 30% of the line amount. The rest of it you can only use while you're swiping. Sorry, sorry about that. And then the last example here on this slide is equipment loans. So for an equipment loan, you're using that loan to buy some sort of piece of equipment. So, you know, just based off of some of the examples I've heard from business owners here, if you are, you know, if you do remodeling for buildings or residential homes, you would take out an equipment loan if you need to buy something like a forklift or, you know, some sort of or vehicle so that you can transport things back and forth. Again, equipment loan is similar to just a regular loan, where if you don't have $100,000 around in cash in your checking account, but you need that money to grow your business or start it, that's when you would take out a loan. I'll stop there, maybe give it like 30 seconds.
So I think it's probably better if we just take shorter sentences and pause just for like 5 seconds, Isaac.
Okay,
You're
you
fine.
got it. Yep.
Yeah.
Yep. Okay. Yeah. Then you had the same idea. Perfect. Okay. So when it comes to, I'm just going to break these down and give 3 different examples. All right. One example for each one of these loans. Okay. So an example of when you would ask for a term loan is, let's say you are starting your business and you are, and you need money to renovate your space. And it would cost you about $100,000 to renovate this space, right? This is a great example of where you would use a term loan, where we would give you a certain amount of money based off of the project, and that would be used to pay to renovate your space. So again, an example of where you need $100,000. You don't have that money sitting somewhere in a checking account unless you win the lottery the next day or the day before, and you go to a bank and say, hey, I need $100,000. I don't have it, but I can pay you in monthly installments until we're good to go. With the business line of credit, it's a little bit different and might be a little bit more complicated. So what a line of credit is supposed to be used for is for short-term expenses. So I think I heard that someone makes, it might be a bakery, right? I'll give you an example of a bakery, right? If you are if you're a caterer, right? And you have a big project coming up. So maybe you're working with M&T, and M&T says, hey, I need you to make 1,000 cupcakes for this next meeting. But to make 1,000 cupcakes costs you about, let's call it $1,000. It's just a very simple example. If it costs you $1,000 to make 1,000 cupcakes, but you don't have that $1,000 sitting somewhere, you would use your line of credit. You would pull $1,000 to make all those cupcakes, and then, you know, do the catering event and then get paid. But the thing is, between the time of making those cupcakes, you know, purchasing the ingredients, getting ready for the event, and going to the event to when a company will pay you, that can take a couple of days. That could take a couple of weeks, actually. That could take a month for you to get paid. So between that month, there's that lag. There's that time where you spent all this money and you're not getting paid. So what business owners do is they pull from a line of credit to make sure that they can conduct business. And once they're paid, they pay off the line of credit. So the idea is that you are pretty much pulling from the line of credit to complete a job, and it doesn't have to be cupcakes. I mean, think about all of your different industries out there, but you're pulling from your line of credit to pay whatever expenses you have out there in order to get you to the finish line. And when you're at the finish line, meaning you got paid, you paid down that line of credit in order to keep that afloat. So that's just one example, depending on what your industry is, whether you're in construction, you kind of want to think about how long does it take for you to get paid in order to function, because you got to think about it. You do a large project, and if you're not getting paid in time, well, guess what? Yeah, you have a large project. You have the money is not sitting in your account. You have other bills to pay. So that's where that line of credit comes in to make sure that you're afloat until you finish that payment. And then an example of equipment loans, I think I threw out an example out there, but if you are, we'll stay with the example of a caterer, right? If you have to make thousands and thousands of cupcakes or cakes, right? And you have to transport those. When you're starting out, folks use their own vehicles to do it. But at a certain point, you're going to get into a position where you need a larger vehicle in order to transport those. Or maybe because if you don't do that, then you're doing multiple trips to complete one job. So what people do is they buy they'll take out an equipment loan to buy a vehicle. And with that vehicle, they're able to get jobs done faster. And in turn, that's supposed to be making you more money because of that. I'll stop right there. Give it 10 seconds. Sorry about that, Danny. I got carried away. All right, we'll jump to the next slide if that's okay with everyone. So at M&T Bank, we are the number 6 SBA lender in the whole country. So what that means is that we have the ability to provide SBA loans efficiently and fast. So we have designated lenders that are SBA designated lenders. I won't go too in depth with this, but what we do is we have an SBA loan program that allows us to provide lending to startups and to businesses that maybe wouldn't be able to get funding in the traditional route. So I know some of you, just from the conversation, some of you are starting your business. There's a high chance that if you were to apply for a loan, we would probably do an SBA loan. What the SBA loan does is it allows banks to get a little bit more safety. So, for example, if a small business has an SBA loan and they were to default on that loan, the Small Business Administration, which is a government agency, will guarantee a certain percentage of the loan to be paid back to the bank. So because of that, we use the SBA loan program for a lot of startups. And it's because, when you think about it, when we look at a full loan package, we are going to ask for certain things like business tax returns. Well, we're going to go over that, Jalen. With the SBA, since you are a startup, where we don't have business tax returns. So we have to figure out a way to get around that. And because of that, there's risk there already because we don't, since it's a startup, right? We haven't seen, you know, operations from the business, any financials, how profitable you are. So what we do is we use the SBA to give us some support and to hedge our bet to make sure that we can get this done. Also with the SBA, we're able to stretch out a loan for a longer period of time than we normally wouldn't. So typically, for example, if you have a term loan with a bank with no collateral, so no real estate, no equipment, typically the longest that we can go is 7 years. But with the SBA, we can go longer to 10 years, sometimes 15 years on non-real estate secured loans. Right. I'm gonna give it maybe 15 more seconds and then we'll switch to the next slide. All right, next slide, please. So when you're ready to apply for a loan, one of the most important things is you want to make sure that you are working with a banker that you trust and that you feel is a good advisor. I personally, for me, I spend a lot of time working with, you know, sitting down with business owners and understanding their business, understanding their industry, their need before I give them an application. So on this slide, I think on the English side, you may not see the actual wording, so I'll go over it in Spanish. The folks that speak Spanish, you guys are in luck there. You get to see the captions, but everything is, it's always going to depend. But for documentation for a loan, we're going to ask for some personal background information. We want to know who you are, especially if you're a startup. We want to know what that means, right? We want to know who you are. What is your experience? What were you doing beforehand? Sometimes that's in the form of a resume. Sometimes it's included in your business plan. So if you are a startup and you don't have tax returns, yeah, and I think it's not showing just because you need to download the PowerPoint. I can, if it's, you can send this PowerPoint out to everyone afterwards if that's easier. And you know, this PowerPoint is for everyone pretty much, but
Thank
you know,
you.
what I'm
Yeah,
saying
I think
here is
I
pretty
think I
much
have it
slide.
opened elsewhere on my computer and it's just, sorry about that, but
No worries.
it'll be up on our site when we're done. Yeah. Actually, it's
So,
already up on the site.
and then again, a business plan. So when it comes to business plans, if you're a startup, I highly recommend that everyone has a business plan, especially if you're looking for lending. Banks want to know everything about the business. We want to know what the business is, what you're selling. Have you done the research? We want projections. So we want to know what you're expecting to make, what are your expenses, and what are you going to profit? And usually we want 3 to 5 years of projections. And then another thing that we'll need is we want to know your personal financials. Luckily, all of us, none of us have been born yesterday. We've probably paid taxes and filed tax returns a few years. So in that situation, we're going to ask for 2 to 3 years of personal tax returns, because when it comes to lending, although it's a business loan, you are going to be a personal guarantor. And we want to make sure that we have a full picture and we also understand your personal income and your personal expenses as well too. So I know there was a question about credit scoring and all of that, and we're going to go over that. And that's why we asked for income tax returns. All right, give it me 10 more seconds or so. All right, we can go to the next slide. Okay, so we are on documentation for the loan. So I think it's a little bit higher, and so it'd be should be a little bit higher up. Maybe that one, yeah. So you see, it's all blank there. So and this slide isn't as important, so that's fine. I'll just go over
I'm gonna
it.
see if you can bear with me. I'm gonna see if I can
Yeah.
pull up the other one. I don't know why. I'm afraid I'm
Yeah.
gonna lose all of them, so bear with me for a second.
Yeah, no worries.
It's gotta be here. Um, So for some reason, maybe here
I think
it is.
if you go to,
I think I
yeah,
just
there
found
it is. Yeah.
I did have it, and then
Mhm.
bear with me. I saw it. Here we go. No, that's something else. Bear with me. Thank you, everyone. Well, we're in Spanish now, and hang on, I just saw it.
Can I ask a quick question? Well,
Yes.
while you're looking for that. So I think Edna, and I also had a question when you said non-real estate secured loans. Does that mean basically if you don't have a building or some type of real estate to use as collateral? Is that what that means?
Right, exactly right. So it's loans where, for example, if you are taking out a term loan, and sorry if I'm pausing, I just want to make sure, I'm assuming it's also being interpreted in Spanish, but so when you have a term loan and you're fixing up a space, you might not own that space. It might be something you're renting. So there's really no collateral we can take. So what we do is we'll take a general security agreement, which means we just take a blanket lien on all of your assets. Danny, the question was, what does non-real estate secured loans mean? So does that pretty much is if there isn't real estate, what else can we take as collateral? And we're going to go over that as well too. I think there's some background noise.
Yes, there's somebody that can check to make sure you're on mute. I'm looking to see who might be off mute.
Thank you.
Can you hear me?
Yes.
You can hear me. Okay, great.
Yes.
So,
thanks.
We understand that not everyone's going to own real estate, right, in a small business space, but we still want to give loans out. So there's times where we can even go unsecured on loans. So we wouldn't take any collateral. So it'd be a unsecured loan. Or what we do is if, for example, you're taking out a loan to renovate a space, and again, it's $100,000 loan, we take a blanket lien on all business assets that are non-real estate. So what that means is, knock on wood, if we have to collect, if a bank has to go collect because the loan defaulted, we will take your chairs, your computers, your whatever we can take that we can resell. That would be our source of collateral. So it's a way for us to get around the whole real estate, that we need real estate or vehicles or anything like that. Hope that answers your question.
It does. Thank you. I appreciate it.
Yeah. Okay. So the next slide, please. So a little bit of more information on documentation for the loan, and this should be on your business plan. So what we're going to ask for is, loan history. So we want to know, does the business have existing loan debt? Are we paying it as agreed? If we're going to want some bank statements. So if, for example, let's say the project costs $100,000 and you're asking for $80,000 from the bank, and you're saying that you're going to put in $20,000, you're going to spend your own $20,000, the bank is going to want to confirm that you have those funds. We want to make sure that if you're saying that you have $20,000 sitting somewhere, well, we're going to ask for bank statements just to confirm that. Collateral information. So if collateral is being offered, we want to know what that is, right? So if you're purchasing a building, let's say that's in your business plan and that's why you're looking for money, we're going to need the purchase agreement. We need to know the address of the property. We want to know what information is there. So if you're buying a property, is it turnkey? So you'll be able to, the second you close on the transaction, you can actually just move in there. Does some work need to be done? If so, what work needs to be done? If you're buying a vehicle, we want to know what the vehicle is. We want to know the make and model. We want to know how much it costs. Do you have a bill of sale, et cetera, et cetera. Use of loans. So if you're saying, hey, I need $80,000, we want to know what the money is going to be used for. So you have to be as very specific as possible when it comes to use of loan. We want to know what every dollar is going to be spent on. So if you're saying, I'm going to spend $20,000 on remodeling, you have to be as very specific as possible. What are you remodeling? Are you using a contractor? Who is that contractor? That is where we want to get to a space where we know exactly which every dollar is going to be used for. The SBA, it's a government agency. So with the SBA, if you use an SBA loan, they will be very, very particular about that. And you will not get funding until we know every single detail about the use of funds. And then the last thing is a debt schedule. What a debt schedule does is it allows us to fully understand all of the existing business debt and personal debt. And in that schedule, we want to know, all right, you have this loan. How much do you pay monthly? What is the interest rate? When is it going to be paid off? And what is it secured by? So that we're able to fully understand what your obligations are, or the business obligations are, I should say, and your personal obligations, and to make sure that you're able to afford this loan as well too. I'll stop there for maybe 15 seconds. All right, let's keep moving. So this portion, I'm going to talk about what a bank looks at for lending. At the end of the day, business owners want to, you guys care about, getting your money, right? At the end of the day, you guys care about your money. And when I said you want to make sure you have a banker that you trust and that you feel like is an advisor, this is the big thing here. In my job, what I do is when I meet with a business owner, I'm asked questions regarding the 5 C's, because when I have to work on my write-up and I have to present this to the bank, they're going to ask about these 5 C's. This is how they make their decision. And I'm going to go over each and every one of them. And if there are any questions in between the 5Cs, I'll address them. I know there are some questions out there, so I'm also going to address those questions. But yes. So the first C I'm going to talk about is character. It's funny, in Spanish, there's only 4 C's because character is not a C out there. But the 5 C's, so character. We want to know who you are. Again, the business, you're there, it's a business loan, but it's being given out to a person, right? The business owner is going to guarantee this loan. So when you're going to borrow, we want to make sure that we understand who you are. That's why we ask for a resume, or that's why your banker, when you meet with them, they're going to get to know you. We're going to ask for personal tax returns because we want to know what your personal income is. We're going to run your personal credit as well because that's extremely important. We want to know what your history of repayment looks like on the personal side. Now I'm going to go to capital. So what capital is, if you have a $100,000 project again, right? So you're asking for $100,000, you have a $100,000 project. We're going to ask, how much money are you willing to put down? It's the same as when you buy a house and you have to put in a down payment. Banks don't like to finance something 100%. There's times when we do it, but everything has to look perfect and it all depends. But the more money that a business owner can put into the business or into the project, the better it looks when it comes to lending and to getting that loan. Oftentimes, the rule of thumb is a bank is going to finance 80% of a project. So you're willing to put 20% down. There's times that we go higher, there's times that we go lower, but there's also times that we'll 100% finance a project. Everything needs to look good. So all these 5 C's are equally important. If everything looks good and maybe one thing doesn't look good, we can still get around it. And I'm going to go in depth about that later on. If for some, and then I'm going to talk about how the SBA also gets involved here in a second after I go over all of them. The next C is capacity. What capacity is we want to determine the business's ability to pay the loan. So if you're asking for an $80,000 loan, what we do is we say, okay, if it's $80,000 at 6% over 5 years, can the business afford it? And what we do is that's when we look at business tax returns, personal tax returns, and the business plan and industry standards to make sure that we can afford that loan. Conditions, again, conditions is very important because the only way that you'll understand your business is by doing your research, right? So conditions are external impacts to your respective business. So understanding what impacts your business and the things that you can't control. So understanding that if you're a restaurant, understanding the risks and how do you get around those risks, right? So the conditions for a restaurant versus the conditions for a medical office or a doctor's office are completely different, right? And the predictability of sales, the predictability of making income are completely different. So some industries have more risk than other industries, but every industry, every business has risk, right? If there's no risk in small business, I think we would all have our own small businesses out there. So I commend you all for taking this risk and understanding that There's risk out there, but there's also a lot of reward as well too. And then the last C is collateral. So what is the bank taking as collateral to make sure that the bank feels secured, that if for something were to happen, if a loan were to default, the bank would be able to recoup its funds. At the end of the day, banks are not collateral lenders. We do not lend based off of collateral. So oftentimes, business owners will come to us and say, hey, I have this house that I can put up for collateral. I need $200,000. It's great that we have that piece of property, but what's more important is the ability to pay that $200,000 loan. The collateral just serves as a safety net. At the worst case scenario, if we had to liquidate, if we had to collect on collateral, can we get our money back? What I tell people is, if you're looking for a collateral lender, there's a really great example of one, and that's a pawn shop, right? Pawn shops really don't care about your ability to pay. You go to a pawn shop and you give them your diamond engagement ring or your wedding ring or whatever. They want to keep that wedding ring because they know they'll make money off of it versus the actual loan that they gave out.
Can I ask you a question on the collateral that you're talking about?
Yeah, sure.
Okay, so your example of a business that wants to put their house up, let's just say, for collateral. It's a two-part question. One, if you have, so me and my husband are married, the deed for the house is under his name. Can I put a house up as collateral? If do I have to be on the deed to be able to put a house up as collateral?
Great question. You don't, but it's different for married couples. So if you are married and you were to put your house as collateral, your husband will have to sign off on that as well too. But
okay,
I will say this though, even myself as a banker, I don't want to take unnecessary collateral. And I'm not trying to say I'm not trying to say your primary residence unnecessary. I'm sure it's a beautiful home. But if I'm able to get you this loan without taking your primary residence, we can get that done. With the SBA, they like to take as much collateral. And the only time that we would do something like that is if we have to, if something else doesn't look good. So for example, if maybe your credit score is lower than what we need it to be, or market conditions are risky, or you're not injecting 20% and you're only going to inject 10% or 5% equity in, that's when we would take a primary residence or take extra collateral to feel safe.
Okay, so the second part of that question is, I agree with you. The house is the last option, obviously. But if that's what it came down to for funding, right? What would be the difference between a home equity loan or a business loan?
Yeah, great question. So there's tax advantages to taking out business loans. So with a home equity loan, when you pull from your funds and you incur interest expense, with home equities, the only time that there's limitations on when you can write off interest expense with home equities. Normally, given the tax law right now, this got updated back in 2017. You can only write off interest expense on a home equity for home improvement costs. So if you were to use that money for anything else, that interest expense you can't write that off. So it's pretty much like taking out a personal loan.
Okay.
The other thing, there's a lot of other differences out there. Home equities, you can stretch out those payments for like 30 years and the bank doesn't really care what you use the money for. You can go to the casino with home equity funds or a personal loan and the bank probably wouldn't bat an eye, but the rate is normally higher on a home equity And depending on the bank, it could be a variable rate loan with a home equity.
So the term is longer, the rate is higher, you pay more versus a smaller interest rate, a shorter loan.
Yep.
But basically, there's got to be a lot more proof and receipts and where each dollar is going, right? Am I understanding
Yeah.
correctly?
Yeah, and then with the and with sorry about that, I was getting a few messages. And with business loans, when you apply for a business loan and you get it approved and it's all said and done, those business loans actually don't show up on your personal credit score. They will show up on your personal credit score if there's missed payments, then it's a negative view. But with a home equity, if you max out your home equity, that shows up on your personal score. So when you apply for credit elsewhere, that's going to be taken into consideration for your debt to income, et cetera, et cetera. Now, I'm realistic. I know people, there's people that do take out home equities to fund their business, but I just want you to understand that if you're able to get a secure business loan, that's going to be your best bet. I would say your backup plan is to take out that home equity to fund your business, but there's so many benefits of a business loan, not just the tax write-offs, but it's gonna make your books a lot clearer as well. And again, it's gonna be cheaper money versus your home equity. And you don't want to tie up your personal assets with the business, because if you need to sell your business, if you need to liquidate the business, it could be an issue as well too.
Okay, can I ask you one more question?
Of course.
As far as it being a startup business and, they're not having real estate as a kind of as a backup or a default for them to obviously collect on if you default on the loan.
Mhm.
How would you be able to get like, for instance, instead of having a loan, how would you be able to get a line of credit for a startup business if you don't have credit established for that business? Do they go by the guarantor's credit?
Yeah, so for startups, it's heavily weighted on the guarantor, right? So, business credit is just it's hard to understand and it's hard to quantify. There are business credit scores, but what business credit scores are, it's measured by a few things. It's measured by length of time in business.
Sorry, Isaac,
your,
we're just getting a request for everybody to slow down just a little bit.
oh, sorry.
Thanks. And that's the questioners also. So if you're asking a question, maybe slow down with your question. Thanks.
And I can maybe paraphrase it or repeat the question as well too. Maybe that's helpful.
I have a question for you, if you don't mind.
Yeah, actually, just the last person asked that question. Can you repeat it just so we can all hear it?
Sorry, can you hear me?
Yep.
So just my question is, if I wanted to get a line of credit versus a loan, if the business hasn't established credit, then how would I go about getting a line of credit? Does it go by the guarantor's credit?
Yeah. So the question is, if there is no established business credit, no history of business credit, how does a business get a line of credit or even a loan? So when you look at the 5 C's, right? Business credit goes under character. So when you think about all the 5 C's there, if that, startups are weak in character, right? Because of the fact that there's no established business. So what we do is we have to make sure that every other C in this chart, in this diagram, are good. So if character is weak, for example, again, your example is no established business credit. Also, it's a startup, or maybe personal credit score is weaker than normal. we'll use the SBA as we'll use the SBA loan program to get you to that line of credit that's for that loan. So if you remember what I said about the SBA program, it gives banks a guaranteed amount of money back in case you were to default. So what the SBA guarantee is, it's a form of collateral, right? It's just like a piece of property. If the loan defaults, the bank is going to try to get its money back. And the SBA loan program is an excellent way for the bank to get some of its money back. I'm just pausing so that the interpreter can interpret.
And Isaac,
Mhm.
I'm a little concerned, and I don't, maybe this is normal, but it concerns me that Ciamaro may be considering putting her personal home up as collateral for a business. Like,
Right.
like it
Then-
seems to me.
That's the last option. Just saying, I know that is
Yeah.
the last option. I just don't want
La-
to rule it out.
But even
exactly.
as an option, like, should it be even on the table as an option?
Right.
Like, that's what I'm
It-
saying.
It should be a personal residence is going to be last resort. And just for the interpreter, the question was, or the statement was, the concern of having to put your own personal home up as collateral for a business loan. What I would say is that is completely last resort. I've been doing this job for about 7 years, and I've probably used a personal residence as collateral maybe 5 times. That's it. Normally it's for SBA loans, where the SBA loan program wants to take as much collateral as possible. But again, as a banker myself, I don't want to take that much collateral because it can be expensive, it's time consuming. So what we do is we want to make sure that we can just take business assets as collateral versus personal homes. So, that when you think about your home equity, that's the downside as well too. With a home equity, it's your own personal residence to fund your business. So that's what I always say is, if you can get that business loan, if we can take business assets as a lien, that's where we want to be. We don't want to take personal assets there. We've done it. Sometimes you just got to do it. It's a necessary evil. But if everything looks good, if all the 5 C's look good, we shouldn't have to be in a position where we're taking personal assets. Does that answer your question, Yamada? Either you're on mute or you are just excited and perplexed at my answer that I got.
No, sorry. Can you hear me now?
Yes.
Okay, so I said, yes, it definitely answers my question. I do have another one, but I don't want to monopolize the time here if anybody else has a question.
I saw one question. The question was, if you have 2 business partners applying for a loan, one has perfect credentials and credit, and the other does not, will you have a chance of being approved? Great question. The answer is it depends, and it could get approved. So there's loans where we're able to do that. And what I mean by depends is, the questions that I'll ask is, what is the ownership structure? Is it 50-50? Is the person with excellent credit and credentials 80% and you just have an investor at 20%? It all depends. With loans, I will say this, not every owner needs to guarantee the loan. So for example, if one person is a 90% owner and then someone only owns 10%, we're fine with the 90% owner only being the guarantor, especially if that 90% owner is a person that's managing the day-to-day business and the 10% owner is just an investor or someone, right? If it's 50-50, we have to look at everything else, right? We have to look at the 5 C's. So again, character is weak, right? In this example, so you have someone who has great credit, but then you have someone that has like a 520 credit score and might be weak. We're gonna I'm gonna ask, well, how much money, or if I'm gonna go to capital, right? I'm gonna look at the $100,000 project and see how much money are you putting down. If it's $100,000 project and you're only asking for half of it, 50% of it, that looks good. We might be able to get around that. We might be able to get away with the fact that someone may have really bad credit. If the business is able to pay the loan and has shown on their business tax returns or projections, or maybe their personal income, that they look good and they're able to afford the loan, then we're able to get around the fact that someone has really bad character, not bad character, sorry, may have a lower credit score. I can go on, but I think you see my point there. Again, if there's collateral, so we may not go unsecured with someone that has a weaker credit score. That's when we may ask for extra collateral to get us to feel comfortable there. Hope that answers your question there. I'm going to stop there. We have about 5 minutes or so. I'm more than happy to go to talk more and go after 7. But what other questions are there?
¿Cuál es el límite de crédito para comprar un negocio? ¿Es lo mismo que una casa?
Okay, can we just remember to everyone, please slow down just a little bit. Gracias.
Señora, ¿puede decir eso otra vez?
¿Cuál es el límite de crédito para poder comprar un negocio? ¿Es lo mismo que una casa como 650, 7, 8 o es algo específico?
Yep. So her question was, what is the, when you're buying a business or you're trying to get a business loan, what is the, pretty much asking is it similar to like buying a house where there's a minimal credit score, et cetera, et cetera. What I would say is you want your credit score to be as high as possible, right? You want to get to a position where you're above 700. If you're lower than that, that is when you're going to have issues, right? But what's more important than the score is what's actually impacting the business, what's impacting your personal credit score. So if you have a 700 credit score, or if you have a 600 credit score, 650 credit score, I will ask you, why is your credit score so low? I'll give you, what we do is we look at everything that's showing up on your credit report. So the score is important, but what's more important is what's showing on your report. So what's your debt to income? How much debt do you have out there? Have you missed any payments? That's more important than the actual score. So I'm going to pause for a second for the interpreter.
Para un negocio, si yo tengo un crédito de 800 y cumplo con el 20% para $100,000, ¿yo puedo comprar un negocio sin tener evidencia de que es un restaurante y nunca he tenido evidencia de vender comida? ¿Se puede hacer eso?
So her question is, if she has an 800 credit score or high credit score, and is she able to take out a loan even if she's never had experience with opening up a restaurant? So that's her example of a restaurant. In that example, it is possible. What I would say is you still need that business plan. You still need the personal tax return. So we're going to look at what your personal income is. We're going to look at, do you have a business plan? If you're buying a restaurant, that restaurant has financial statements. It has tax returns. It's been in business for a couple of years, I hope. So they're going to be able to give you those business tax returns. And if nothing's changed, if nothing is going to change between the previous owner and you buying the owner, we can assume that the financials should be very similar. So we'll be able to use those business tax returns to understand the ability to pay. So if you're buying a restaurant for $150,000, what we're going to do is we're going to take that $150,000 loan, stretch those payments out for 10 years. We look at the business tax returns, how much money that business makes every single year. And then we say, okay, if the loan is going to cost, if she's going to pay $25,000 in principal and interest payments on this loan, is she able to pay that loan with the business net income? And that's why we look at those business tax returns. So your personal credit score, that 800 credit score, it's phenomenal, remarkable that you have an 800 credit score. But what's more important is the ability to pay, because for that example, you might have an 800 credit score, but you might still have a lot of personal debt out there. Between someone who has an 800 credit score and someone who has a 700 credit score, the person who has an 800 credit score, they might have $1 million in debt out there, but they make those payments every single month, but they still have an 800 credit score. That person who has a 700 credit score, their debt to income might be a lot lower, so they don't have as much debt payments every single month compared to someone who has an 800 credit score. So what's most important is the ability to pay that loan based off of a business plan and projections and business tax returns and your personal tax returns. Sorry, I'm done there. I'll stop there. Sorry, Danny.
Gracias.
De nada.
Isaac, thank you very much for going through all this. I think everyone is probably interested in knowing what the likelihood is of how they'll be received at a bank if they haven't already. And we had an M&T banker a number of years ago share with us that it's helpful for the banker to know your story, to like what you're saying, like that you want to know about the business. You want to know that they care about dogs and have been taking care of dogs forever, and they've already had a dog walking business and have been whatever. But can you talk for just 1 minute about that before we wrap up? Like, should people be going physically into a bank and introducing themselves to the branch manager? Is that helpful in this day and age of we use a card to pay for everything and we don't ever walk into banks, hardly ever?
Yeah, so I understand the intimidation of going to someone and talking about something very important. When I think about going to a bank or talking to a banker, it's kind of similar to, going to a doctor's office and telling them that something's wrong with you, or going to a dentist or a therapist or anything, right? It's, you're making yourself vulnerable. But the right banker is not just someone who writes you a check. A banker is supposed to be an advisor. So what I would say is, when you're ready to talk to a banker, go to a branch. Go say, I want to meet with the branch manager, or ask your friends, ask your colleagues, ask your fellow business owners, where do they bank and who do they work with? For me, for anyone that's local, I'm more than happy to have a conversation and meet with you. I'm never going to sell you on anything. I'm never going to twist your arm. But, I pride myself in saying that I usually meet my clients out for coffee. I want to make sure that I'm the right fit for them and they're the right fit for me, and that I'm setting the right expectations. And there's times where, I give advice and I can be harsh, where I'll say, hey, listen, maybe you need to consider X, Y, and Z. But you want to make sure that you're working with someone that you trust, because guess what? They're going to be the ones that are writing the loan report. they're the ones that are creating the loan package, and you're going to be your cheerleader, your support system. I want to make sure that I know the full picture. So, it can be, some folks, you can go on the internet and apply for a loan, but I've seen very, very scary things and horror stories of folks going to apply for a loan online. And guess what? They're getting quoted high interest rates for money that they can go talk to a trusted advisor and get a lower interest rate. Or what's happening is they're getting payment terms that aren't great, or and the reason why is because you're putting your information into a computer and that's it, versus talking to someone, getting to know someone, working with someone that's been doing this for several years and can give you advice. But again, I want to make sure that I know your information. Your banker, the right banker wants to know everything so that they're giving you the right recommendations. Because what happens too is someone says, hey, I want to get this loan, I need this. And then we come back and say, well, actually, you actually need X, Y, and Z. And you find out that you really needed a line of credit, or you needed a term loan or a business credit card. And there's so much more that a bank offers than just loans, right? Our checking accounts, credit card processing, fraud control, cash management. There's so many other things out there that when you go on the internet and you look that stuff up, you should do your research, right? I'm not saying don't do your research, but you want to make sure that you talk to someone, because it could be like, if you like, I'll give you an example. Let's say you have a cough or a sore throat, and you go on the internet and you put in those symptoms. WebMD is going to tell you that you're dying, or WebMD might tell you have this or something, versus going to a doctor, someone who specializes, and they can say, hey, this is what you need to do, right? So I say, go talk to someone. In small business, it's all about people. I think you all know that. It's all about establishing relationships, working with customers. Banking is the same way. You want to make sure you know your banker, you trust them, because that's the name of the game. I'll tell you, in my world, I don't win unless business owners win. So that's why I spend so much time working with folks. I think someone asked me if I'm in Rochester. My territory is more in the Buffalo world, but I have folks in Rochester. With M&T, we're all over New York State. More than happy to connect anyone who wants to meet with someone in person. I have a lot of colleagues everywhere that I do trust. But I'm more than happy to connect anyone. And I'm more than happy to have a conversation on the phone or email. And I'm sure you'll probably send my contact information to everybody. More than happy to connect. I'm on LinkedIn. I love supporting small business. So if there's folks out here that are local and I can pop in and just see what's going on, I'd love to do that as well too. Perfect. Anything else I can address, or any other questions I can answer?
Can I comment on that? I know that Lauren and I interviewed, I guess you would say, a few banks, and I'm proud to say that we have settled on M&T, and working with Sean Dwello, who is the branch manager at Seneca Falls location.
Nice.
And when Lauren and I walked out of that meeting, it was a feeling of, wow, she's going to help us succeed.
Mhm.
She's family, and she's going to be a part of our team. So kudos to yet another branch manager in Seneca Falls for M&T.
That's awesome. I'm gonna send them a note for sure. I appreciate that. And
Yeah.
we're invested, right? We want you to succeed, and we're not just here for the loan, right? Of course we want to get you that money, but it's not just about that loan. It's that's just short term, right? It's also about making sure that you have the right bank account and make sure that you're accepting payments the right way. And me as a banker, I meet with folks probably at least 4 times a year at the minimum with my customers, because I just want to make sure that I'm providing the right service. Banking is always changing. You hear about banks in the news all the time. There's so many crazy things happening, but you guys, I make sure that you guys know what's happening. If there's any products out there, any services that may help you out, you might be starting out, but you might be growing. And as you grow, your needs change. And that's where you want to make sure you have that great relationship with your banker.
Thank you, Isaac. We're going to have to leave it at that right now because we have a workshop coming up shortly here. But
Awesome.
Isaac, we really appreciate it. And I did hear you say that you're on LinkedIn. So I would encourage people to connect with Isaac de los Santos on LinkedIn if you are on LinkedIn. And then Isaac, you're welcome to stay for the rest of the program, or you're welcome to hop off, either or.
I'm gonna grab dinner and a few drinks after this. I appreciate it.
Okay, so
thank you so much for your time, everyone.
No, really appreciate it, Isaac, and to M&T Bank for your sponsorship of this cohort. So thank you, and everybody, we're going to take a break till about 7:15. If you can take 5 minutes, and then we'll get Dave Richards is going to join us. Thank you.
Take care. Bye.
Thanks a lot, Isaac.
Thank you, Zach.
So till about 7:15, 7:16, if you need 1 extra minute, we can stretch it to that.
To please try to slow down just a little bit when you're asking questions.
Tanya, would you like to, we're going to get started. Would you like to introduce Dave and then we'll, I will be running the slides here. So Dave, you could just tell me when you need to go to the next slide.
Very good.
Sounds good. So for our workshop tonight, we're going to be talking about your financials. We're going to work with Dave over the next 3 workshops. Dave Richards is a certified mentor and SCORE volunteer. He works with SCORE. We've talked about it a little bit. SCORE is a nonprofit association dedicated to educating entrepreneurs and helping small businesses start, grow, and succeed nationwide. Dave works with SCORE in Rochester, and I had the pleasure of working with Dave through some entrepreneur classes at a previous job I had, and he's mentored a lot of the entrepreneurs that I've worked with since I started with Ibero. So I highly recommend if you like what you see, that you reach out, and if Dave can't help you, he can find the person who can. So I'll let you go, Dave.
Thanks very much, Tanya. So as Tanya said, my name's Dave Richards. I'm a certified mentor for SCORE. A little bit about my background. I've been a SCORE mentor for almost 15 years. I have my own consulting business, which I do entrepreneurial coaching. And prior to that, I was in commercial banking and also economic development, where Tanya and I had a chance to work together. So we can go to the next slide. As Tanya said, SCORE is a national not-for-profit associated with Small Business Administration. There's over 3,000 3,000 people working at SCORE as volunteers, and 3,000 chapters of SCORE itself. Locally, we have about 100 volunteers, and we can go to the next slide. Similar, SCORE and Ibero have been partners, and our goals are basically the same. We provide free local support and resources. We provide mentorship We can provide alternate forms of financing or find financing sources for you. And we have a plethora of online resources to help you out. Next slide. The goals for the presentation, and as Tanya said, we're going to be doing this over 3 separate dates. So, for example, tonight we're going to start with the purpose of financial projections, cover our startup costs, and start to work on putting together a sales forecast. The next time we'll talk about costs, and the last one we'll put everything together so you have a final financial plan for you to use for your banker, your investor, or just for yourself. So we'll go to the next slide. There are a variety of different reports that are included in a financial plan. As Isaac said, these are the things that the bank is going to look at: your personal financial statement, your balance sheet, your profit and loss statement, your cash flow statement, your startup budget, and your source and use of funds. The focus for the presentation for these next 3 days or next 3 meetings will be just the profit and loss statement. Next slide. So what we want to look at is how do we arrive at what the profits are going to be for the bank in terms of numbers of units sold, dollars of product or services sold, to figure out what we need to sell in order to break even and then start to earn a profit. So the things we're going to look at are what's driving our revenue, what are our profit margins, obviously what our costs are, and eventually get to a break-even chart and the calculations to reach that. Next slide, please. I understand you just finished working on your business model canvas, or it's still in process. And we are focusing now at the bottom 2 rectangles of the canvas, dealing with the cost structure and your revenue streams. I hope all of you have been able to identify those costs that are key to operating your business and what different revenue streams you're going to be counting on to make this a successful venture.
Dave, I'm just going to ask maybe that we slow down just a little bit with some
Okay.
pauses for the interpreter. Thanks.
Yep, no problem. So we can go to the next slide. We're going to be using a template that SCORE makes possible. Down below in blue, it's actually the spreadsheet link, but I don't think you folks can access the link. But if you go to the SCORE website, just score.gov, and look for resources and look for financial projections, that spreadsheet will be available to you. It looks quite overwhelming. It's about 9 or 10 pages long, but it includes all these items 1 through 6 that we will be working on together. So we go to the next slide. The first thing that we want to do is, how much money do we need to get your business up and running? So you can see the various categories that we're going to be looking at. Most of the top part being fixed assets, or those assets you need to operate. You could be buying a building, you could be renting a building, you might be buying equipment, furniture and equipment, and fixtures, a corporate vehicle. So we come up with a total of what your fixed asset purchases are going to be, even before you get the business up and running. You're also going to want to see what kind of cash you're going to need to get the operation going. In most cases, when you get insurance for your business, they're going to require a prepayment, an advance, usually a couple of months premium payments. Inventory is an estimate of what you think you need to carry from a startup point to get your business up and going. If you're forming an LLC, you might need to have a legal attorney work with you to do that. You might also need to hire a CPA to help you out. Then there are other upfront costs that you probably will see: utility deposits, maybe a rent deposit. And you're going to want to advertise and promote your business before you open. So that totals the fixed assets and the operating capital you need to actually get your business up and running. So the question then rises, we can go to the next slide, please. How are we going to get all this $213,800? Part of it is going to come from owner's equity, that money that you have available to put into the business. As Isaac was saying, the bank is going to want you to put some skin in the game. So maybe it's 10% of the total cost that you're looking at. You might have outside investors, and then comes the bank or other funding sources, your commercial loans, mortgages, credit card debt, and other forms of bank debt. So each of those sources have to equal to the 213.8 that we had in terms of money we needed to get started. The great thing about this particular page, it doesn't show, but it automatically calculates your loan payments and other debt payments as well that will then go into your projections. Or we can go to the next slide. One of the hardest things for people is to figure out how do I know what my sales are going to be? I haven't been in this business before. I need some guidance as to what I think I need to have for my sales. So one thing that we do often with clients is go to a website called bizstats.com, and they have a listing by NAICS codes. If you're familiar with that, it's a government identifier of different types of businesses. And you can go through this list if you go to that website and find an industry that's pretty close to what you're doing. This happens to be a brewery, and you can see their sales are 100% of sales. The cost of goods sold is about 40%. Gross profit then is 60%. Coming down to a bottom net profit of 13.53% of sales can be counted on to be a net profit. Now, one thing you want to do is look at this listing of expense categories, because you might not have all these in your business. For example, it's not likely that you're going to have a pension profit sharing plan the minute you start up. So you can add that 1.62% to the 13.53 to get a higher net profit percentage. So go to BizStats, try and find a comparative industry printout like this for your business, and then we can go to the next page. So from the previous slide, the net profit percentage was 13.53%. And as you're starting up, you say, how much money do I want to earn? What's my profit goal? And so I said, I want to be able to take $50,000 out of this business in my first year. And understanding that my net profit percentage is 13.53, I do the arithmetic, calculating 50,000 divided by 0.1353 means that I need sales of $370,000 almost to allow me to earn $50,000 in my business.
So Dave, we just need to take a pause periodically. So when
Yeah, I'm
Danny,
sorry.
that's okay.
Yep, I get
Thanks.
rushing on this stuff.
Thanks. That's okay. I know we all do.
Any questions on how to arrive at that number?
Dave, I also put the link for the projection sheet right in the chat, so they'll have that and a link.
Thank you
to
for the link.
stats.
Yeah, great. Thank you so much.
Yes, thank you.
So we can go to the next page. Now that we've identified that we need $370,000 in sales, we have to look at how we're going to generate that. What kind of products do we have? Services, packages, volume. What we're looking at here is that bottom box in your business model canvas, your revenue streams. Where are you getting the money from? From the brewery, they had obviously sale of beverages, they had sales of food, they had merchandise, they had, various other things that they could sell. So in that projection template that was just sent out, you'll see that there's room to put your revenue streams in the sales categories, and we'll get there in a second. But the key is to figure out, how am I going to get to that $370,000 in sales? And you consider, your revenue streams, what you're going to be selling it for, and what the costs are. So we can go to the next. This basically is just another way of looking at what our unit of sale is in terms of dollars and units being sold. For your products, you're going to have a unit of sale, and you're going to have a sales price. Services, you're going to bill by the hour, or maybe by a total project cost. And all that will help you determine what your price per unit sales is going to be. Obviously, the goal being to at least break even and then make a profit for yourself, so that you're getting your $50,000 out of the business. And go to the next slide. This is from the template. Oops, this is actually, we're getting into the expense categories. We could stop here because we're going to get into expenses next time. I know that's a bit short for tonight's presentation, but I'll leave it open for questions at this point. How many people are just overwhelmed?
You know what I can do is go back to, I think, the profit and loss statement and a couple of these that you are explaining, which
Yes.
I think repetition is always very helpful with this
Sure.
type of thing. And not sure if I'm on the right slide.
Well,
I think
actually,
I am.
Tanya, can you share a screen with that template?
I'll
I
stop
do have
sharing.
a question.
Maybe.
Yeah, go
Sure.
ahead, Kayla.
My question is just looking for advice because you did just say how many are overwhelmed. And
Yes.
I don't know about everyone else, but it is a lot of information for me.
Yeah.
What would you say would be the best route when we're meeting with people that are going to be helping us with these loans and things like that? What would be your advice as far as, for me to walk in and not know really anything and trust these people with these big decisions? What would be the best, or I should say this, what should I not say or not do?
Well, you want to be able to say that you have a business plan, and you want to say that you have financial projections, and that you have the back, your personal financial statement and tax returns.
Okay.
Most bankers are going to, first question is going to be, can I see your business plan? And if you bring out a piece of napkin with some notes on it, they're not going to be too impressed.
Mhm.
Similarly with the financial projections, if you just say, well, I think I'm going to make $100,000 in sales, and maybe if I'm lucky, I'm gonna make $25,000 this year. Doesn't
Okay.
go over well.
Yeah.
Just it's interesting. A lot of the referrals that we get at SCORE are from bankers who have sent people to us to get the business plan to help with financial projections because the people coming into them haven't had a chance to do that yet. And so we're able to provide that service.
Okay.
The other thing is, not all people do this, but SCORE mentors are happy to go to the bank on your visit too. In some cases, it's reassuring to the banker that you have someone on your advisory board, or you definitely have an advisor who's helped you with the financial projections and business plan.
Okay, that's good to know. I was actually thinking that myself, if it would be beneficial to actually have somebody come with you that, has a little more knowledge of what it is that I'm going to be hearing for first time,
Right. That it is helpful, but at the same time, in working with people on developing a business plan or the financial projections, you're the one that has to know the ins and outs of it. So when we go to the bank and the questions are asked, I'm not going to answer for you. You're going to be, the one that they're looking to make sure you understand what you've put down on paper.
Right. Okay.
Yeah.
Thank you.
You're welcome.
Hey, Law, may I add to that, that the more you go through the business plan and the more you look at over the next few days of these classes, and we go through these numbers that Dave is suggesting, that your startup costs, what you think you're going to sell. I think I'm going to sell 100 cupcakes by next Tuesday. You're projecting. It's an imperfect science. Sometimes there's guessing involved, but
Yep.
you're going to know in your head what you think you're going to do. And the more you are prepared to know know thyself, as they say, the more what you're doing, you're not going to jump into anything. The best thing you could do is not borrow money if you didn't have to borrow money. Don't go into debt if you don't need to go into debt. But if your business relies on getting more funding in order to grow, then you're going to make sensible decisions. A lot of bankers tell me, we don't want to set you up to fail. We don't want to lend you money that we don't think you can pay us back. So I would not, like Isaac said, don't be intimidated by a banker. But also there are we're not talking about this right now, but there are alternative lenders. If you get turned down by a bank and you feel like you really would like to pursue a lender, there's other lenders in the community, which we can talk about at another time. How do you feel about that, Dave?
No, I agree entirely. And part of the effort to do a business plan and do your projections is to come to a go, no-go decision. So you might not need the banker to say, I don't want to give you the money. You might come to that decision all by yourself, thinking, after going through, it's a lot of hard work to put this all together. And a lot of, thinking goes into, am I willing to, in some cases, quit my W-2 job and start working for myself? That's a big step. So you want to be sure you have all the confidence that you can get by having done all this homework.
Did you say you wanted us to pull up the financial projections?
Yeah, we
template?
could, if you could do that, we could sort of fool around with it.
I'm going to see what I can do.
I'm sorry, Anne, without Augustine here, it is not letting me do that. So,
Oh, no, I got it. I think I got it. Can you see it now?
Yep, there it
Yes.
is. So that gets you to the, you're going to need to download it, I think.
yeah, it's at the top of that little paragraph, and you'll see that there's a blue right below the picture. of the lady, there's a blue bar. And if you
There you
click
go.
right on that template.
I think I actually have this on my computer, but we'll get the actual one here.
It's the one that we have gone over with Augustine before, yeah.
Let me see if I can pull it over. It's coming up on my other screen. Bear with me.
I can access on my computer if you let me share
No,
screen.
I'm gonna, sorry, it's up, but it's on the other side. So just count to 10.
Okay,
1, 2, 1, 2. Okay, now let me try to share this. I got it up now. Okay, now tell me what you see.
perfect. So
Okay, so
this is the first page, which gives you some of the directions. But up at the top, you can see you put in who's prepared this, what your company name is, what your starting month is, starting year. And this is so on the top of the columns of your projections, you will have the correct starting month and year for you to look at. And just as you look through, those in the dark orange are where you enter data, and the others you can adjust as you need to. If you need to do any changes, the sheets are locked, but to unlock them, it's just 1, 2, 3, 4. So then if we go to the number 1, this is probably looks a little familiar. This is where you can go in and actually input all your data in terms of fixed assets and operating capital.
So for example, Dave, like down, like where it says real estate land, and I realize, I'm sorry, this is all in English right now. Is that my personal real estate or is that my business real estate?
This is all business related. So if you were
So if I
buying a
don't own
building,
if I don't own any business real estate, I'm not putting anything in there, but I
Correct.
might, if I have some equipment already, like let's say I have a couple of machines, am I putting in the value of the machines or it's something that I need to purchase?
typically this would be what you need to purchase.
Okay, so I need to buy 2 new machines and it's gonna cost me $2,000. So I would put
Right.
it in like that?
Yep.
And what's that number 7 under there? Oh, those are the
Oh.
years. Okay.
Yeah, depreciation is, an accounting thing where
Yep.
you paid cash out of 2,000, but you're gonna have the expense over a 7-year period.
So let's go down to a couple more. So the furniture, so I need to get some fixtures, I need to get some shelves.
Yep.
I need to get like another $2,000 worth of stuff. I'm gonna put
Yep.
that right in there.
Yep.
I need a vehicle for my cleaning business. I found a good used one for 10,000. I'm gonna get that. I'm gonna put
Yep.
that in there. There's always other. So if I put in 15, well, I'll just stick with 1,000. So those are fixed assets, meaning
Right.
those are things that they're not changing every day.
Correct. Then the next part is going to be mostly your upfront deposits and inventory and other things that you need day one when you open your door. So you're going to have to pay a prepaid insurance premium probably.
It's probably more than 1,000, but I'm just putting.
Yeah, just for numbers, sure.
So your inventory, let's put 2,500. Legal fees and accounting fees, let's do 1,000. Maybe not. So everyone, you're going to be working on this over the next few days. So when you see this, just to get a sense of some of the numbers, like you may not have all of this, right, Dave? Like
That's correct.
I may not be putting a number everywhere. Maybe I don't need any licenses. You know, there might be a couple things that don't pertain to you. Working capital, you probably want some cash on hand to get what you need.
Right. If you're a retail store, you want to have money in your cash register.
So you want to explain then at the bottom where it says total required funds?
Right. So the total between the fixed assets of 15,000 and the
That's here.
8,500 in operating cash means you need $23,500.
Right down here.
So then we know what we need to raise. So then we go down to the next section that shows how much am I putting in myself? Do I have any angel investors? Do I have any loans outstanding to get me to that 23.5?
So the owner's equity, that's me putting my own money in.
Correct.
So I've saved $5,000. And where do I put that in?
In the
Whoops, sorry.
dark orange.
Okay, sorry, I was in the wrong.
That's okay.
Okay. And then I have some friends that are going to give me 2,000.
Right. So if you look down below total funding needed, you can see that it says you require more funding. So we need 16.5 from somewhere else. So maybe you got a truck loan for part of it. You had a $10,000 truck loan, 10,000. Chances are they're not going to give you all 10,000, but that's a good way to do it. And then maybe you get a small.
Is the credit card debt, meaning you're suggesting that, not suggesting, but that's if someone chooses to use their own credit card?
That's correct.
Okay.
I wouldn't recommend it, but it's there just in case.
Yes, we don't recommend it. So let's just say a commercial loan, perhaps then would
Yep.
be $5,500.
Right.
So you're balancing out that bottom line.
Yep. And it gives you the message you are now fully funded. Anyone have questions on how Ann did that? If not, why don't we go over to 3A sales forecast year one? So up top is the product lines. Those are your revenue sources. So yeah.
So I have a retail store. I'm selling shoes, hats, coats, and gloves. I
Right.
live in Western New York.
So then in units, you want to put in how many units you think you're going to sell in a month. So how many shoes am I going to sell? And at what price am I going to sell them? And then I'm selling them for 20, but how much did it cost me to purchase them to resell? So I'm going to have a gross profit of $6,000 for every shoe that I sell. And we can do the same calculation for each of the other sources of income.
I think when I remember doing this before, I think what's helpful is if they look down here.
Yep.
Under the product line, it automatically is putting, well, it's not yet, but it puts the words under the product line.
Right.
You know, we're going to be going over this again, but don't get overwhelmed, everyone. This is just the overwhelming introduction.
And with that said, please reach out if you start working on this and you have any questions. You can email me or Tanya can get you my info. I'll be glad to help you work through it, either on this or anything else coming up.
Okay, so that just gives an example, but then
Right.
it populates. How does it populate down here?
Okay. So we said we're going to do 10. So up here, we would put in 10.
Oh, got it. So I'm gonna put that in because I said
Yep.
we're gonna sell
it-
10 there.
Yep. And so it automatically calculated what your sales are, what the cost of those sales were, and what your profit margin is.
Do you guys see how this is filling this up? So all we did is put in those 4 product lines. You can think about what you want to put in there, cupcakes, cakes in a cup, whatever. And then the number you think you're going to sell for the month of April, May, June, July. But I love that it calculates that, Dave.
Yeah.
That it shows right up like there, your total sales, the cost of your goods sold, and your margin.
Right. The beauty of this also is if you have any seasonality in your business, you can change the monthly unit sales. So there, some businesses do a gangbuster sale in December. So that might be 20 units sold instead of 10. They might not sell anything in the winter. So maybe that goes down to 5 or 2 or whatever.
And it all just fills in for you.
Right.
And the nice part about it is you can only fill in where it allows you to in the orange. It doesn't let you put it in the wrong spot.
Right.
Thank you, Tanya. That's
Mhm.
helpful to know.
Yeah, it all looks very overwhelming, but we're here to help you with all of it.
That's right.
I
And we
think
can-
it's helpful just to see how simple it is once you realize what you're putting in there. I'm
Yes.
putting in a name. I'm putting in how many units I think are going to sell in 1 month. That's what I forget, Dave, like units.
Yeah.
I need to be reminded that it's per month.
So that's the hard part. If you go to the next one, 3B, that's just going to take your original information. And as you can see, it's going to project out for 3 years. And the way you do that is in the 1, 2, 3, 4, or line number 7 and 8. You could see the growth rate.
Oh, up top here.
Yeah. So in growth rate, you can see your 10 went to 11 because it was a 10% increase in sales. And
So when the
growth rate-
banker was saying 3 to 5 years of projections,
Right.
this just did a 3-year projection in less than a second.
Right.
It's really filling in some initial numbers. I think we're all going to look very official by the time we finish these.
Right. You
Dave's
wouldn't be
help.
surprised. You'll be glad to see your banker smile when you show them this. So
I
there,
think this is, go ahead, Dave.
no, I was just gonna say, I think it would be helpful if we had this for the next couple of sessions. It's one thing to talk about them, but I think showing it this way is very, very helpful.
I agree. I feel like this has been a really great introduction to it. And
they'll need, I think it's tab 7, Anne. Can you go over to?
Yep.
And we won't get into all of the 7 at the bottom. I'm sorry.
You have
I
to go
know,
all the way to the left to get out there. There
I
you go.
see 6B. I have to go to the left to get there.
Yep,
Oh,
there you go.
keep going to the left.
Yep,
Got it.
yep.
Oh, okay. The income statement. Yes,
Yep.
thanks, Tanya.
Is it I don't think that's the,
Are
Well,
you
this,
looking?
you could do the next one.
what they'll
7B? This-
need for,
very-
yeah, 1 through, that's what they'll need for the pitch competition.
Right.
That was the sheet we had them do last time.
And you can see it's 23, 24, 25. These are this is an income statement
Right.
with
But
numbers
next
you've
time-
plugged in. Yeah.
Yeah, next time we can review the sales again, but then we'll get in and fill in the operating expenses and salary and wages to complete the picture.
That would be great, Dave. So thanks for everyone for bearing with us through the Excel form. I'll stop sharing so to give you a break from it. Does anyone have any questions or comments at the moment? Did anyone understand a little bit of it? Once
Oh
you
yeah,
see
I
all-
definitely understood. Thank you.
Yep,
Great.
you're welcome. Get in touch with us if you have any questions. Tanya or I can help you with these. And I see some people that I've met before, like Amy and Lauren. Hi.
So Dave, thank you very much for going through this. I know we're asking a lot when we start talking about financials, but kind of going through this Excel form, showing how it can complete forms for you, can complete all these reports. Tanya, thank you for suggesting this one, the income statement. That's great. I forgot about that. That's part of the whole package.
Right.
Does anyone have any questions before we sign off for the evening?
Thank you, everyone, for your patience. I know that this is quite overwhelming.
We're not expecting you to do this by yourself. We're going to be here. So take a deep breath, relax. Remember to pause when you're speaking. Everything
We
is
have
going to
2
be
more
fine.
workshops, plus you can call or email us anytime.
Yep, we can set up one-on-ones to go over this, so don't be worried. Is anyone checking, Tanya, the chat? Let's see.
Nope, I don't see anything. No
Okay.
questions right now.
All right, everybody. Dave, thanks again so much. We'll see you on Thursday, I believe.
Yep,
And
same time.
see everybody else on Thursday, and have a wonderful rest of your evening.